Joining us, Komal Sri-Kumar, President of Sri-Kumar Global Strategies. Good to have you this morning, Sri, given everything that's happened.
Thank you for having me.
What the last week, what would you say happened? How would you summarize it? What were your thoughts with the carry trade, Japan going up, the Fed not moving? Did you think they should have?
No, I don't think the Fed should have moved in July, and I don't think the Fed should move in September. So I think what happened over the past week were the developments in Japan, the first rate increase in quite a long time. Japanese interest rates have been too low, and the Japanese are the major creditors to the rest of the world. So when the interest rate went up, it made it more attractive for the Japanese to take the money back. And global investors, in turn, sold when they found out that the yen appreciated massively in reaction to higher Bank of Japan interest rates. So that's Japan. Now, coming over to the United States, I think it carried over to here because of the expectation that high valuations in tech caused a tech drop yesterday. And then you had the overall market taking fright over the possibility of a recession. Now, the other thing to touch upon, Joe, is what is happening on the recession side. An important development yesterday, momentarily, it happened for a few seconds, is that the 2 to 10 yield curve actually became positive after being inverted for 2 long years. What it says to me is, yes, the risk of a recession has increased, and that is what is also showing up in the market correction last week. The Fed should not act, Joe, because I don't think the Fed should act in response to simply the markets. That is not the mandate. The mandate is economic growth.
But the markets moved because of the jobs number.
The markets moved because of the jobs number, but what was wrong with the jobs number?
I don't know, you tell me.
14,000 jobs created. Very healthy. 4.3% unemployment rate, not very high. Wages are still rising significantly. Inflation is above the Fed's target. So the Fed has 2 mandates: keep up economic growth and bring down inflation rate. Both of them are in the process of happening. Why do you need to change?
Because if at this point we're at 114,000 and suddenly all the companies that we're hiring look around and say, it's always a loss of confidence. It's always something psychological. And if they suddenly decide there may be a slowdown coming, I'm definitely not going to hire now, and then it just becomes self-fulfilling. And the next job number could be under 100,000. It could be, who knows what could happen at this point. You could see a lot of companies just pulling their horns from hiring quickly.
That is definitely a possibility. But let's go back to looking at the numbers and what it may signal. We had about 114,000, 115,000 jobs a few months ago. Then it picked up and went up again closer to the 200,000 number.
We don't know if that's going to happen again.
That may well happen again.
Or it might not.
Or it may not. But the thing is, why do you need to move before that shows a panicky Fed cutting interest rates? Then what are they going to do? Increase interest rates again?
I don't know. But if they are now, if they've stayed too long, which a lot of people say, that when you saw Jeremy Siegel say they need to do 2 75 basis point cuts just to get back where they should be. You think that's definitely not the case?
Yeah, I strongly disagree with the Jeremy Siegel position. The problem today started in 2020, 2021. Excessively easy monetary policy accompanying a very expansionary fiscal policy. Both of them coincided, with Jerome Powell telling us that he's not going to be concerned about the fiscal policy stance. He's going to do what he is going to do on the monetary side. My economic theory education suggests that that makes no sense at all. And once you have done it, and you're going to cut interest rates to 0, and you're going to double the balance sheet from an already bloated level, which is what the Fed did, you're going to have inflation.
So did they stay at 0 too long, and are they making the same mistake, staying restrictive too long?
Once you have stayed at 0 too long, you're going to make a series of mistakes.
That's what I mean. The die was cast back then.
That is correct.
There's no perfect outcome now.
No perfect outcome. What I would suggest is hereafter, I've always suggested have a rules-based policy. Data dependence makes no sense to me.
That's the last thing they have. And people that ask for that,
then you lose all flexibility.
They get pilloried.
I want you to lose flexibility.
I understand that you want, but then what happens in a true crisis?
In a true crisis, you have, like if you follow like a Taylor rule, my professor for my PhD committee, you are looking at what's happening to employment, you're looking at what's happening to inflation, and based on that, you move interest rates. So it is responsive to economic conditions. However, you do not move to every single month's numbers to employment and inflation. The problem with being data dependent is the long lag that very many of these effects have, and you're not able to adjust to it. And Andrew, that's the basic problem with what we have. Is I call it forward confusion. Ben Bernanke said forward guidance gives you a better guidance as to which way the market is going and adjust. But what you have is if you have wrong guidance, it is just the opposite.
So you don't want you can make the case that who doesn't want a rules-based system? Make the case to me, because I know Judy Shelton does one, and it drives liberals crazy. John Taylor wanted the Taylor rule. Used to drive.
I'm not sure.
No, can you just explain it to me? Because there's people even here that drives them nuts when they hear rules-based. What is it?
I have a suggestion. Andrew may have one as well. Let me tell you what it is that's wrong with rules-based policy.
Yeah.
None of you need to come to work every day. You can stay home, and the computer will do your job because you have all the information.
That's true too.
But a seat-of-the-pants approach, like any, it depends on who the Fed chair is. So one person can decide whether they ruin the economy or bolster the. We got to go though. They're playing us out.